Silver continues to be an asset that historically has worked very well with inflation.
Hey, welcome back to The Dive. Our guest today will share his thoughts about Russian gas alternatives, silver, gold, as well as his investing strategy given the current environment, his thoughts on some charts about energy stocks to US equities ratio, S&P 500 real earnings yield, and a chart about Argentina's 6-year credit default swaps. He's a partner and portfolio manager at Crescat Capital. Tavi Costa is joining us today. Hey, Tavi, welcome back to The Dive.
Thanks for having me.
Okay, so Tavi, I want to start with oil. The EU and the West has imposed sanctions on Russia, from travel bans to asset freezes. Do you think that there could be an alternative to Russian gas? And if so, what do you think, or where do you think that Russian gas alternatives come from?
Probably the US. I think the US is probably going to be one of the places where we might see large exports to places like Europe in the future. So LNG ports and LNG investments in general are going to be probably one of the places that we may see shifts along the way that might be very helpful for some energy companies. We've been invested in some of those. And so, yes, I do think that this deglobalization period that we're seeing and geopolitical issues may actually translate into some opportunities in the energy space here in the US.
So let's talk a little bit more about your overall investing strategy. How are you positioning yourself given the current market environment?
I believe we're in a bear market personally, as far as the equity markets go in the US. So we're short the equity markets in the US, and we've been long commodities and tangible assets. So we believe there's different buckets that we like. We like metals, we like energy, we like agricultural commodities, and we have a little bit of uranium as well. We also have other investments like in Brazil, because we think it's an economy that may actually do very well in this macro setup that we think we're entering. And so the easy way to think about this is that we have a large inflationary book that is long commodities, and then we have our hedges. Our hedges are short equity markets, short technology companies, mega cap companies, and other consumer discretionary businesses that we think will get squeezed by margins and so forth. We are firm believers that we are entering a recession. We might be in a recession already, but I think that more important than that, I think corporate earnings and the newspapers of today are all about inflation. I think the next newspapers of the next 6 to 9 months are going to be all about the demand falling apart. I think demand is going to fall off a cliff. And by cliff, I really mean that because earnings are literally at peak right now. And so there are too many factors that I think are systemically hurting earnings today. We got the rise cost of capital. We have the wages and salaries. We have the material costs in general. And then now we're going to see the demand fall. The demand fall is going to come from many aspects. Is consumers are getting squeezed as well. Inflationary problem is one of those. Sentiment of consumers is very low, historically low. And now we have mortgage rates increasing too, and asset prices declining. So all those things are going to factor into, in my opinion, a major contraction of corporate earnings in the next it could last even 2 years or so. And I think that's going to be the next step. And that's going to create a policy dilemma in a very significant way.
So you do think inflation is here to stay then?
I do think inflation is here to stay. I don't think it's going to go away, but I think we've seen most of the first wave of inflation. Inflation usually happens through waves. And so we've seen the first one. I think we've seen the majority of that. Certainly something could happen and could cause another spike in inflation. But as of now, my view is that inflation is at a point where it could decelerate a bit. So we may see inflation stay at least above 6%. We're using CPI, which is a terrible gauge for inflation, but using that as a gauge, let's just say CPI stays historically high. And as we see the corporate earnings situation deteriorate and the economic activity deteriorate, I think we're going to see unemployment rate start to increase. We're going to see, look at initial jobless claims begin to increase already since March. Technology companies have been in a bear market since February of 2021. So it's a matter of time for us to see. And technology companies is a very large percentage of the labor market today. you would think that at some point we're going to start seeing the deterioration of the labor market. And that's going to be an important part because right now policy making is all about inflation. And that's a big part of it, tightening monetary policies and so forth. But what if we have the labor market is starting to show some big problems, especially when the unemployment rate starts to rise? They're going to have to rethink about their policies if they're going to be injecting liquidity in an already inflationary environment. That's what the Japan route was so far. Japan has been doing that. Or you could also continue to tighten monetary conditions and let things break even worse. Perhaps a very steep recession, which is also a likelihood. So, how do you position here? I continue to think you want to hold things that are going to serve as a safe haven in the future. Those things, in my opinion, are gold and silver and other things, but mostly gold. And other things are not in the safe camp at all. So I'm quite concerned.
Yeah, let's shift and talk about the precious metals. We wanted to get your read on the silver market right now.
Well, silver markets have been not so good as far as relative to gold. We've had the gold to silver ratio continue to widen, and that's positive if you are a long-term investor. The thesis is still here, right? Silver continues to be an asset that historically has worked very well with inflation. We've had one of the biggest tightening cycles as far as reversal from monetary loosening to tightening in history. And, just thinking back to 2 years ago where we were as far as money printing, not too long ago, we were still printing money to buy treasuries and suppress rates and so forth. Now we're in a very different world where long-term rates have been rising because of the supply issues of too much issuances of treasuries. And so it is kind of natural to see that painful moment to impact markets like silver and the miners. Gold has been holding up very well. I think silver continues to be a buy because it's going to be very useful. There's a very smart investor, Chen Lin, that has put a very good case for solar panels and silver, and the drastic increase in demand for solar panels in the following years in China that will follow along. And we think that that's going to be another factor, another tailwind for silver, which is about 15% of its demand today, and it could actually be even more in the future. And so silver is a green metal. It falls into this green revolution in a large way too. And I think it will continue to be a very strategic metal. And we know that the problems when it comes to supply in areas like Mexico and Peru are very challenging to produce silver. And the difficulties geologically to find silver are also a big component of this bull case for silver. So as a monetary asset, I think that with gold starting to run here, as we see this policy-making dilemma that I've been calling, I think we're going to see silver do well as well. But it's time to be accumulating. I wish I had the crystal ball when things turn, but to me, I think it's the cheapest metal on earth, as I said before.
Now, gold. We see Switzerland imported gold from Russia for the first time since the invasion of Ukraine. Do you think that we'll see more imports from Russia from different countries moving forward?
I read those news as well, and I have a lot of questions. I wish I could speak with the report, and I should actually, because they mentioned the word receiving gold, and they said importing on top. So is Russia selling their gold to Switzerland? Is Russia just trying to place their gold in Switzerland? There were questions there that I wanted to get across. But in my opinion, look, I think gold continues to serve, especially now with the deglobalization trends heating up, and I think they began really in 2016 or so when Trump started to question the relationship with China, and we've had that certainly that move intensified during those times, and things have never changed since then. In fact, I think Democrats have only embraced even further that idea as well, along with the China and U.S. relationships getting worse, and now Russia coming into play as well. And with that, you start seeing the demand for things like treasuries declining. We've seen the holdings of treasuries by China actually in a declining trend, now hitting new decade lows. That's a big deal. And to me, that's the big part of where gold is going to play a role here. Just because we're entering an inflationary regime now, central banks need to restore or attempt to restore their credibility. They're going to have to hoard gold one more time. And so I think that this is going to be the next leg of the gold move. It's going to be driven by central banks, not only from the demand side of foreign central banks avoiding buying treasuries, but now buying gold. But on top of it, we may see also, I think, even the reversal of some tightening policies because of the deterioration of the global economy over time as we get into this stage of the demand cliff that I think we're going to see. And so I'm very bullish on gold in general. I mean, my portfolio is kind of static on gold. I mean, it doesn't change much. I mean, we've been buying high quality assets in the space. We're not selling most of those assets. I mean, those assets are most times are very static. If anything, we're just adding to them. And so I'm not the right guy to ask about gold and moves in the 3 to 6 months, but I'm very bullish. I think it's hard to believe gold is going to be trading lower 5 to 10 years from now. So I think you want to buy when things go lower.
So let's talk about some of your tweets that you've posted about your different charts on Twitter. The most recent is the energy stocks to US equities ratio. Could you walk us through your thoughts here?
Yeah, well, I think the issues with energy are structural. It has to do with the capex trends that energy have been really constrained from investing in the space and creating new projects and even through from exploration to production, even refineries and so forth. And so it's hard to believe that those trends are going to reverse very quickly, and especially with the political pressure on top of it. But and so if you look at the valuation of companies today, despite the appreciation of most of those stocks in the prior, call it 20 months or so, they're still really cheap. They're still trading at 9% or so in aggregate free cash flow yield. And so, and you can find also some very attractive dividends as well in some of those stocks. And so it's quite interesting to find from a shareholder perspective, the attractiveness of that whole sector, I think. And I believe that as part of the value to growth transition that we should continue to see in the following years, I think energy is going to play a role into being that value side of that component of the value index that should appreciate relative to things like technology over time. And so I'm very bullish on energy still. And now we've just had a very big decline recently in energy and oil and natural gas and so forth. So a lot of things look very short-term oversold. And I think it's just a good a place to be buying the dip in commodities and selling the rally in overall equity markets. But again, that's just my view.
So let's shift and talk about your S&P 500 real earnings yield chart. What is this chart telling us?
It's telling us that how expensive valuation in terms of valuations we are as far as equity markets. And it is amazing how many folks, including even myself at some periods of my career, have really linked today's markets with the 70s and the 1970s, where we also had inflation. But the problems today, as far as the macro imbalances, are far more concerning in my view. Well, the debt problem, I think it's needless to say that the government debt problem, the corporate debt problem are very concerning in the US. And you include even household, which is not as much as a problem because they have relocated the issue to the government side. The overall debt picture of the US is concerning. But that's no news. And then you have now the valuation problem, which everyone was always not concerned about that because of the excess of liquidity. But now when you start seeing cost of capital rise, profitability matters and valuation matters and fundamental analysis matters. And so you start seeing the re-rating of the more expensive parts of the market. And so we've seen some of that since February 2021. A lot of hype and overvalued names have been declining. So I think that chart just shows you that earnings yield is just one way to look at relative to inflation today. When you adjust that for inflation, you can see that we're far more overvalued than we were even in the worst times that we saw back in the 70s. And in my view, that creates the political constraint that I think is important. David Einhorn said that the policymakers are really bluffing now, and I completely agree with that. I think they're bluffing because I don't think they can tighten financial conditions too much more than we've seen so far, because something is going to break. And that is just because of the nature of how the imbalances have grown over the years. And usually you see reckoning moments when liquidity dries up at those stages. We're in a debt spiral, and it's going to be difficult and almost impossible to see monetary tightening sustainably happen here that is not going to create issues. And so, I'm a big believer that this is the beginning of a bear market. That's why I think that's quite concerning.
Okay, so I have one more chart to pull up here before we let you go here. What about Argentina's 5-year credit default swaps? What is this telling us?
Well, I think that's all linked to this idea of parts of the market or the global economy is interconnected first and foremost, and it cannot handle this level of monetary tightening from developed economies. Throughout history, we've seen in the last 2 to 3 decades, we didn't have much of that same level of shift from one very loose policy to now very tight policy. And so this is quite concerning, especially from developed economies. We're seeing 10-year yields across the globe rising. We're seeing that in Europe. We're seeing that in Japan. And a very unpopular opinion to me is actually that we may even see there's a much higher probability than most people believe that we may even see things like hyperinflation one day in Japan and in Europe. And I don't think it's too far from now, because their need for commodities is much higher than other places. They are not blessed by the fact that they have a lot of natural resources to explore and develop. And so that is going to be a problem over the next years, especially with the place that is just highly indebted historically. And so Argentina is a place that I've been always concerned. I think Argentina politically is headed towards something like Venezuela. We've seen the issues of smart money leaving Argentina for many, many years. You don't become a country like Venezuela in the course of a year or two. That happens. It's a progression that tends to happen over decades or so. We see, deterioration from the political side. We see the currency side being a monetary crisis. Argentina has been facing a monetary crisis for many, many years. And so it's easy to see the impact of developed economies having to remove liquidity from the system, from the global economy, and how that spills over places like Argentina that are already fragile. And so, for me, this is just a sign of how things are starting to break as we get into more of a bear market, the later parts of a bear market. So I'm quite concerned that something is going to break if they don't stop tightening significantly here.
Last time we spoke, you were liking Brazil as a region for different commodities. Are you still liking that?
I do, especially now because they sold off a little bit, and some of the companies actually sold off significantly. And along with the markets, they behave better than the markets, which is kind of interesting. Brazil usually should be getting crushed when equity markets in the US, NASDAQ was down at the lows, was down 35%. I think we're due for a bear market rally personally, and that's how we are positioned now in our funds. We're not as short as we were, and our approach to this is very systematic. As equity markets start to get to those levels, we increase our long exposure, and one of the places we have increased has been Brazil, to answer your question. We also, as the market goes up from here, so we've seen something like 6 percentage points of appreciation of the S&P 500 since the very lows of, if you look at a daily chart. And so, we start relocating capital into the shorts as we see those moves. And so, that has been our approach. And who knows, it could be a 15-20% bear market rally or not. And if, so we don't remove all of our shorts, but we're not as short as we were 2 weeks ago. And but we're looking into it. If things just start getting frothy again, as far as, well, things are frothy, but if things just start going up again, it's going to give us another opportunity to go really heavy in our short positions.
Well, thank you so much. That's all we have for you today, Tavi. It was nice to talk to you, and we'll see you again later.
Thanks for having me.
Thanks so much for watching the Daily Dive. We'll have more for you tomorrow, so be sure to hit that notification bell and subscribe below before you leave us. Bye.